You open your app. Yesterday, everything was green. Today, the entire market is red. Bitcoin down. Ethereum down. Almost every coin falling together. And it feels strange, because millions of people around the world didn't suddenly wake up and decide to sell at the same time. So, what actually causes a crypto crash? Is it panic, bad news, or manipulation? The real answer is more mechanical than emotional. Most people assume markets fall simply because investors get scared and sell. Fear does play a role. But fear alone cannot explain why crypto prices sometimes drop 10 to 20% within minutes. Human decisions don't move that fast. What moves that fast is automation. And this is where crypto behaves very differently from traditional markets. A large portion of crypto trading uses leverage. Leverage means traders borrow money from an exchange to open a bigger position than their actual cash. For example, with $1,000 and 10 times leverage, a trader controls $10,000 worth of crypto. This increases profit if price rises. But it also creates a strict liquidation price. Every leveraged position has a point where the exchange automatically closes the trade to prevent the borrowed money from being lost. This is called liquidation. And liquidations don't wait for human decisions. They are executed instantly by algorithms. Now imagine the chain reaction. Price drops slightly, maybe due to news, a large sell order, or macroeconomic events. Some leveraged traders hit their liquidation price. The exchange sells their positions. Those forced sales push the price lower. That lower price triggers more liquidations. More liquidations push the price even further down. Within seconds, thousands of automated sell orders hit the market. This is called a liquidation cascade. And this is the main reason crypto crashes feel sudden and violent. So, the crash is not just people panicking. Panic may start the move, but leverage accelerates it. The market begins to sell itself automatically. After the cascade finishes, the selling pressure disappears. That is why crypto often stabilizes quickly after a sharp drop. The system removed the risky positions. So, next time the market drops sharply, remember, it wasn't millions of traders making the same decision at once. It was a network of automated liquidations reacting to price levels. And that's why crypto rarely falls slowly. It falls in waves.